What is up, and welcome back to How to Invest in Commercial Real Estate. Super interesting topic today that Brian's going to dominate. Just putting that out there in the beginning.
Brian is going to take the lead for once, and I'm excited to hear what he has to say.
I'm going to talk about attending the Thunder game last night where they closed it out and headed to the NBA Finals.
Guys, if you are not watching the best team in basketball,
then you.
That's gonna come back to hurt.
Then shame on you.
So I'm totally biased because I'm a huge fan, but I'm going to give a little plug for the Thunder for a second. We lost Braden. We lost him. He's gone. Oh, dude. The Thunder might have an argument for the best team in the history of the NBA.
Yeah, now, look at statistics or what?
Yeah, I mean, they didn't have the best record. They had one of the best records in the NBA.
Yeah,
what they did have is they had the biggest point differential, which means we kicked ass more than any team has ever done it. Right? Yep. Day in, day out, through 82 games, we beat teams worse than any other Supreme team has beat those teams.
How many people outside of Oklahoma do you think are going to agree that the Oklahoma City, this Oklahoma City Thunder team is the best team in history?
Well, I said they have an argument for it. I didn't say they were. You got Warriors in 17, you got Bulls in the 90s, and you got the 76ers team in the late 70s. So I'm not discounting those teams. I'm saying they're in that discussion now.
There's also an argument to be had that it's the worst Thunder team we'll see for the next 5 years.
Yeah, that's true.
They are currently the youngest team in the NBA.
They're only getting better.
Of course, they have to win the championship, so we're a little premature here. Yeah. But anyway, they're super exciting to watch, and they just stuck it to Minnesota last night. So,
Halliburton on the Pacers did a triple-double with no turnovers.
First time it's ever been done.
Wow. Freaking nuts.
No turnovers. Wow.
No turnovers. Triple-double. That's insane. They don't even have a name for it. It's so insane.
All right. Well, so let's get into. No, we got updates maybe first.
Yeah. Any updates? All kinds of updates. We're buying stuff like crazy.
That's good.
Let's see update. Watch your email.
Sign up.
If you don't see the email, you.
Yeah, Tanner is going to have some editing to do. Let's say Brian's going to be like, "Screw you." Why are they laughing so much since Brian said "screw you"?
Oh, yeah.
Are you going to give us any, or are you just going to say watch your email?
No, right now the West Texas, Texas portfolio. Guys, we started calling this the West Texas portfolio, and then we look at a map and realize like none of them are in West Texas.
Two of them are in kind of West Texas. So one's in South Texas.
Yeah. So now we just call it the Texas portfolio deal.
Okay.
And I counted the other day. There's 8 entities so far. We have 8 on these 3 deals.
Wow. It's going to be a little complicated.
It's my job. Yeah.
Yeah, that's going to be a little complicated. But
then we got a Fort Worth property after that.
Yeah, that's in contract, DD expiring soon. So the Texas portfolio deal, it's closing into June. The Trail Lake Plaza, which is in contract in Fort Worth, is closing, beginning of July-ish. And then what else?
We got a couple of properties that we're negotiating LOIs on.
Yeah, a couple that we're negotiating LOIs on, and then we have 2 small development deals that we're packaging into one deal that'll launch, sometime in June here in the next few weeks. We haven't done one of those in a while.
Yeah, but still a lot going on. But today's topic we wanted to talk about, and we've covered it before, but how to utilize 401k, Roth IRA money to get involved in commercial real estate. That money's already set aside for investments. You've been saving it up your whole working life, but how do you get it earning a higher percentage return than just having it in the market? And with the market near all-time highs right now, it could be a good time to pivot to commercial real estate.
Yeah, we're always talking about the money that you have outside of IRAs, how to get a higher interest on that, but we haven't talked about self-directed IRAs or IRAs.
Yeah, so I think first and foremost, let's talk about the idea and the concept. I think if your employer offers a good match, if you're below the Roth IRA income limit, the max contribution is like $7,000. You should probably be doing this.
I agree.
Regardless of where you're at in your investing journey, we were talking about how, maybe you're not doing this, you should be doing this. There's advantages in every stage of your investing career where having some Roth IRA money that you can deploy is an advantage. Second of all, if you're still in that career funding your 401k, you may not be able to have it self-directed yet because it's in the company account, right? That's kind of a big asterisk. Mm-hmm. It's got to be rolled over. Typically when you leave the company or retire, that's when you can put it in a self-directed account.
Right.
And get a lot more access to it.
And always do a custodian to custodian transfer so you don't get taxed. If you do custodian, if you take it and you put it in your bank account, right, it's going to be taxed right away.
If you do that, you're an idiot.
Yeah. So most large employers offer this. Even Precision Equity offers a 401k plan. Most employers offer a matching. That's free money. You should definitely do it. I mean, if your employer says, "Hey, I'll match you 50%." Up to 5% of your salary.
It's a good deal.
It's literally an instant 50% return on your money that will grow tax free until you retire, and so that's a huge win. So we recommend most likely maxing out at least through the employer match, if not all the way to the max, and then also doing the Roth. And just so if there's people that don't know exactly how that works, the 401k takes pre-tax dollars and invests it.
Traditional.
And it grows tax-free. So it goes in tax-free, grows tax-free. So even though you get taxed on the back end, you get all that compounding growth for the 30, 40 years that you're contributing to it. You get all of that, and then you're only taxed as you take it out. The Roth is different in that you take after-tax dollars, money that you've already paid tax on, and it's up to $7,500, I think, now. And it goes in after tax, but it grows tax free. You'll never have to
grows tax free, and you can withdraw it tax free.
Yes,
right.
Grows tax free, withdraw tax free. Unless they change the laws, you'll never have to pay tax on that money. So that's a very, very strong vehicle as well. And to Braden's point, most employers in their plan, they'll offer several investment options for your 401k. You can invest in bonds, you can invest in stocks, you can invest in mutual funds, a lot of different options. But they're not going to offer Criterion commercial real estate investments.
And
right?
usually the only
They
stock
should.
They might do mutual funds, but really the only individual stock they do will typically be that company's stock, right?
Yeah. More funds, different types of mutual funds, international funds, or whatever. So you have to, in order to get control and to be able to put it in commercial real estate deals that you want, you have to leave that job, and that's what you're talking about. Transfer it over. It's called a rollover, self-directed rollover your 401k, and then you can tell your new money manager where you want to invest it.
Yeah. So many people, I went through this week, as a matter of fact, with my daughter. She's starting her first full-time job, and she's going through this. And I recommended that she max out her 401k.
Freaking better. She's living at home.
Yeah, really. She's saving a lot of money.
Mooch.
Fidelity handles a lot of these. And so if you leave that company, you just transfer it within Fidelity to a self-directed IRA.
Nice. Okay, so then let's talk about, you have some stats for us, but there's an amazing amount of wealth held in 401k plans throughout the country.
Yeah, it's currently about $40 trillion. A lot of money.
That sounds really high to me, but I guess we're talking about, probably 100
people.
million people.
Yeah, it's a lot of people.
That's a lot of money. That's the majority. It's probably all in the public.
Let's give the audience some averages by decade of how much people are holding in their 401ks.
Okay.
It's almost like we have these answers prepped.
Late 20s, it's $24,000. Average is $24,000.
Nothing.
30s is early 30s is $45,000. Late 30s $73,000. In your 40s, it's about $100,000 to $152,000, and then at 55 plus, it kind of levels out, and it stays at about $250,000 per account per person on average.
And we don't have the median numbers,
no,
but I imagine those would be quite a bit different.
Yeah, I got to believe that people 60 and over. There's a lot of people that have $1 million, $2 million, so that's really skewing these numbers.
Yeah, and there's a bunch of people that have nothing,
there's a bunch of people that have very little. Yeah.
But the idea is that people don't always have, $50,000, $100,000, $200,000 to put into a commercial real estate deal.
That's true.
But they, using the 401, if you're 40, 45, 50, and you've changed jobs, you might have a chunk of money that you've been saving and it's been growing tax-free for years that you could get access to put into a commercial real estate deal where, let's say the market's near all-time highs. You don't think that it's going to do 10% a year, for the next 5 years, but commercial real estate's an option. You might be able to get 15, 20% compounded. So it could be a good option to consider.
Yeah.
So Brian, what are some of the things people need to think about when investing through their self-directed IRA?
Well, there's a tax. There's a UBIT, unrelated business income tax. And this is where if you invest through your self-directed IRA, that the money that you make in income that's based on the leverage, let's say you had 20% equity and 80% leverage, that amount that you make on leverage could be subject to income tax.
Could be subject. God,
I'm not an expert.
No, and I got to be honest. When we were kind of researching this before the show, I was a little surprised to learn about this because I hadn't heard anybody talk about it specifically. So let's say that you have.
Does that work when you're talking to the IRS? Like, I hadn't heard about it.
Hadn't heard about it.
Probably not. No, probably not.
Hadn't heard about it.
Definitely doesn't work.
But let's say you have $100,000 in a self-directed IRA and you want to, put it in, buy a commercial building. If you bought it all cash, then the passive nature of that income doesn't get taxed. It goes into the 401k, self-directed IRA. Tax-free, still gross tax-free. But when we were researching, we learned about this unrelated business income tax and then the debt problem, where if you invest in a deal that's got, let's say, 75% leverage, the cash flow generated, 75% of it could be subject to some form of tax.
Right.
Now, the good news is that all the expenses and the depreciation that you receive from that property will offset most of that. But we want you to consult your accountant because this is definitely not our area of expertise. But to your point that you were talking earlier, you're still probably money ahead investing in a higher yield real estate deal, even with a little bit of tax, versus just keeping it in the market at an average of 9% a year.
Yeah. At the end of the day, there's going to be people, though, who say, I don't want to make money because I don't want to pay taxes, though. Mm-hmm. I mean, it's kind of, I would like to make more money.
I mean, let's just use an example, the $100,000, and let's say you would make $9,000 on average in the S&P. You'll make $20,000, let's say if you get lucky, on average in a commercial real estate deal. Even if 75% of that $20,000 profit that year could be subject to tax, let's say that half of that is offset by depreciation, let's say. So then you've got $7,500 that's subject to tax. And I don't know what the rate is, but let's just say it's a marginal rate of 30. You're really paying $2,000, $2,500 potentially in tax, but you were $11,000 ahead, and so now you're $9,000 ahead, or you're $8,500 ahead than you were in the S&P example. So I mean, run the numbers for yourselves, but I think even if there is some tax associated with investing with a self-directed IRA, you could be money ahead in good real estate deals.
Yeah, there's another thing. This probably won't apply to most people, but for us, we were talking about how we would do it. There's also a requirement for an arm's length transaction. So we can't
you can't invest it in your own fund.
Deal.
Yeah.
I'm pretty sure that's not legal.
No,
we're going to have to edit. Can we edit?
No, I'm not the manager on any of those deals.
A lot of editing today.
So that's a good point, Brian. What the government doesn't want you to do is take your self-directed IRA and invest it with your brother or your mom or your dad or whatever. It needs to be arm's length. It needs to be kind of a third-party investment. Another thing we didn't talk about specifically is with the Roth IRA, there is no tax considerations.
Yep.
And with the new, improved $7,500 contribution limit, you can build up a decent amount of money in a Roth. And that way you can invest in any commercial real estate deal. It's going to make money tax-free. You're going to be able to take it out tax-free. And so I really highly encourage everybody to be maxing out the Roth IRA, which I have done in certain years. I don't know that I'm doing it every year because I'm just so focused on commercial real estate directly, but I'm going to be looking into that as well.
You're not focused on the $7,000 Roth IRA contribution?
I haven't been. I didn't even know it was $7,500 till the other day.
Shame on you.
I haven't been doing it either.
Because it was like $2,500 to $3,500 like just a few years ago, and they've increased it. So
it's been longer than a few years.
How long do you think it's been?
Longer than 3 years.
We'll come up with an update next week on how long it's been.
Yeah.
But
they can do that.
Anyway, hopefully you guys can have that as a consideration. It's a good way to get started. If you have a self-directed IRA that you've rolled over and you want to get it diversified from the market, if you have any questions, ask your accountant, call us. We'll put you in touch with the right people.
Yeah, I was going to say, we have a couple of companies that do self-directed IRAs that we can direct people towards, right? We don't need to say their names now, but...
It's kind of scary, It's like, do we bring this up to our accountant? Do we just wait and say, well, you should have known,
Yeah.
It's like, I'm scared to pick up that rock. I don't know what's under it. It's like,
Yeah.
oh, yeah, you owe $30,000 in back taxes. Mm-hmm. That's great. That's great.
Great.
By the way, you're fired.
Yeah, I mean, we do have people that invest from their 401k. So
For sure. We give them a K1 like everybody else, though.
yeah, we let them handle it on their side.
Brian's advice is could be subject to, that doesn't help anybody.
All right. Anything else for this week?
Yeah, Orange Monster is the best, obviously.
All right. We'll see you guys next week on how to invest in CRE.
You almost forgot. You almost did.
I was like, should I say the whole word? Do I give the abbreviation?
You're battling with it. All right. See you guys.